This video is all about investing 101. So investing, again, remember, is just the concept of having your savings grow over time by gaining extra interest. That's the goal of investing. And so over time, your ideal goal is to make your investments look like that. The question is, how do you do that? And the answer, by investing into growing asset classes. So an asset class is really just going to be anything you can invest in. So the most popular and most well-known is stocks or the stock market. So stocks, you can invest in specific companies like Nike or Apple, or you can buy general market funds like buy the S&P 500 fund. So that's the primary thing people think of when they think of investing, but there's also a bunch of different asset classes you can invest in. Another one, again, is like a high yield savings account. So you can just put your money in a high yield savings account that gets more guaranteed interest over time. Capital One has a bunch of them. SoFi has a bunch of high yield savings accounts. You can also invest into government bonds or government treasuries, and not just US, but most countries have some form of government bonds. The US ones are just considered the safest investment. You can invest into real estate, housing, apartments, properties. That's another one, but it's also the hardest to get started in because you need the most money up front for real estate. Then there's things that people don't necessarily think of as investments like the stock market, but these asset prices can grow a lot over time, especially if you know the industry well. So a lot of people, they make money trading and flipping Rolexes and watches, or trading cards, sports cards like that, or even things like magic cards and collectibles. So collectibles, commodities, stuff like that are actually, you can invest in those and make these investments grow over time. Again, you really need to know a lot about whatever the specifics you're investing in, though, if you are doing trading commodities like that. You also have a newer type of investments of cryptocurrency called Bitcoin is the primary one that most people know. There's also Ethereum. There's a bunch of smaller ones like Solana, but again, that's another newer form of investment field, and we'll get into that in another video. But when you invest into anything, any one of these asset classes you can invest in, there's only one standard that matters at the end of the day, only one, and that's going to be percentage gain or loss. So essentially it's the question, are you up or down on the investment, and by what percentage? It's the only real metric that matters when thinking about investing. And so if you do the right research, you invest correctly, you can put in continuous investments into certain asset classes, and you can grow exponential compounding interest. So let's kind of just go over a little refresher on the concept of compounding interest. So again, the idea is that you're putting in continuous reoccurring investments at an estimated interest rate that you hope to achieve. And so you can also think about that term interest rate as just your targeted gain percentage you're hoping to make each year. So let's say that you're trying to get 5% targeted interest or targeted gains on an account you invest $50 a month for 45 years. We're going to take a look at this visually. So the yellow line is going to be what a theoretical chart of if you gained exactly 5% interest year over year looked like. These blue bars that you're going to see, that's going to be your continuous investments. So if you just kept putting the same amount in year over year over year without any interest gained, that is what that would look like. It's just a linear growth. But you see there's a big gap there from where the yellow line is and where the blue is. So that's where these red bars, and that's going to be the theoretical interest gained each year. So again, you see early, you're not gaining that much interest, but the key of compounding interest is that over time, the red becomes even a lot more than the blue. So you're just going to be gaining more and more interest each year off that account. And then this pink line is going to be what the actual account value over time is. So it's not just a big, smooth, perfect line like the yellow one, but it's going to follow the yellow one. So if we look at that without the bars and we just look at the two lines, the yellow one is theoretical. So that'd be just if it was perfect, but the world is not perfect. So you're going to have years where you go up, years when you go down, and that's why the yellow line is very choppy, because this compounding interest is all about averages. So you're hoping to average 5% year over year, but if you look at the chart, you're going to have years where you even lose money on the account value. So you see that's a period where the account actually lost and went down. Again, another bigger dip here, and then another pretty big dip right there, but usually the dips are followed by gains. So there's another gain, another big gaining period, and then, right immediate gain period right there. So if you look at the line, although it's never exactly on the yellow, sometimes it's above it, sometimes below it, it's really going to stay very close to that over time, and you see by after 45 years, it's going to be maybe just a little below or maybe just a little above. So another good question is, what is a good target goal for your percentage gains year over year? And if you talk to most money managers, they will tell you somewhere between 5 and 8% is what they shoot for average yearly gains over a long period of time. And again, that means you might have one year where you lose 2%, but the next year you balance it out by getting a 12% gain, and then you might lose 5% the next year, 20%. It's going to go up and down like the pink line. So it's not just going to be like you're going to get automatic 5% year over year unless you put it in a high yield savings account. So before we move forward, I want to go over one common misconception about investing, and this is going to be that it's better to buy a lot of small shares instead of one big share or asset because it will have more upside. And this can be true, but again, that doesn't mean you should always buy the smaller valued items just because you can get more shares, because all that really matters is the percentage gain or loss. So let's look at this example. If you have $2,200 to invest, which would have been the better investment in 2020? And we're going to look at Chipotle, Under Armour, or Pepsi. And here are their stock ticker symbols right here. And so in 2020, the prices of each were this for Chipotle, $738 for Under Armour, and $134 for Pepsi. So if you had 2,200, the notion that, well, I can buy way more shares. I can buy almost 300 shares of Under Armour with $2,200 versus only 2 shares of Chipotle and maybe about 15 of Pepsi. So you would think that going off that philosophy, Under Armour would be the best pick because you can get so many shares of it. And that is possible, but you also might think Pepsi too, you can still get a lot and it might be a safer investment than Under Armour, but again, you can buy many more than you can of Chipotle. But again, all we know is that in percentage gains, all that matters. So let's look at what those prices are at now. Chipotle, Under Armour, and Pepsi. So we see in that time period, Chipotle made a 201% gain. Under Armour actually lost 10%, and Pepsi made a 33% gain in that period. So even though Chipotle was the most expensive to start, it still made the most gain. So your $2,200 would be a lot more if you went with Chipotle. And so you see those gains there at the bottom. What we're going to learn now is how to do that percentage gain or loss calculation. And it's a simple one. All you're going to do is take the new price of the asset minus the old price and then divide it by the old price. That's going to equal M, or your multiplier. And then to get it to a percentage gain or loss, you're going to take M and times it by 100, and that's going to get you your overall percentage gain or loss on the asset. And now we're going to add a third step, and we're going to figure out how much we averaged year over year on the asset. So what you're going to do is you take percentage gain and divide it by the number of years you've been invested in the asset, and that's going to give you A, or the average year over year gain on the asset. So let's take a look at this using an example, and we're going to use Amazon. And let's say that you bought $4,000 worth of Amazon stock in 2013. We're going to answer 3 questions. 1, how much percentage gain did the investment make? 2, what was the average yearly return for the investment? And last, how much is the $4,000 worth now? So let's focus on the first 2 first. So you bought $4,000 worth of Amazon stock in 2013, and that was the price in 2013, and that's the price today. So we're going to focus on those first 2 questions first. And so let's go back to that formula we looked at earlier, new price minus old price divided by old price. So in this scenario, the price today would be the new price, so 187.07, and 1787, the 2013 price, would be the old price. So we subtract it and then divide it. So 187.07 minus 1787 is going to be 169.2. Now that divided by the old price of 1787 is going to give us M, or 9.74. So if we want to get that to a percentage gain, we're going to take 9.74 times 100, which means that Amazon stock gained 947% over that period. If we want to get it to the average year over year, again, we're just going to take 947 divided by the number of years invested from 2013 to today. That's 11 years. So we're going to divide that by 11. And so 947 divided by 11 is going to give us an answer of 86% yearly average gain on that Amazon investment. And now let's go back to that third question. How much is the $4,000 worth now? So we're going to go back to our formula. We're really only going to focus on that multiplier. So all you need to do is find the multiplier. You don't need the percentage gain. Multiply it by the multiplier. So you're going to take the amount invested multiplied by that multiplier number M, and that's going to give us how much it's worth now. So the amount invested was $4,000. The multiplier of M is 9.47, so 4,000 times 9.47 is going to give us our answer. And again, if you had any amount invested into this, you would multiply it by 9.47. So if we go 4,000 times 9.47, it's going to give us, the account value is now going to be at $38,800. Obviously, you wouldn't get to keep all that because you'd have to pay capital gains tax on it. But still, that's a nice bit of extra money that you got essentially from just putting it into an asset. So that is a little wrap up, a little refresher on Investing 101. And as always, take it easy.